Let the free markets decide. And I'm all for laissez-faire type economics. I'm all for free markets. But with the Federal Reserve, we also like some certainty, some anchor of the Federal Reserve. And I think it's going to be difficult. If you let the bond market do too much on its own, so the 2-year yield starts rising, the 30-year yield starts rising, it's going to find a place where it pushes against the economy. It pushes against markets. And that, to me, is not the best way to implement monetary
policy. Is it back
policy.
up in the yield, price down, yield up into 30 years? Is that an opportunity for you to extend duration?
So we love real yield, and we are getting it. And look, in my career, the last 10 years, 15 years, I've been in the industry 20 years, but doing this specifically for about 15 now. I mean, I remember pre-COVID, it was like, oh, we've got 2 to 4% yield and basically no real yield. And that's what we had. Today, I looked at it this morning, we're getting a 5% to 6% yield on high quality corporate bonds. Now, look, I don't know what the Fed's going to do at the next meeting. I don't know what inflation's going to do. I don't know what the growth's going to do. But what I do know is I can lock in 5 to 6% yield for the next 10 years and set it and forget it. We have a retirement income problem in the United States. And now they have income. Now, you got to take it when there's a lot of uncertainty around the Fed. You got to take it when there's inflation uncertainty. But at the end of the day, the yield is destiny in the bond market, and we've got some great yields to take advantage of.
So what did you make of just that steepening we saw in the yield curve yesterday? Is that just reflecting that the market's saying, I don't know what this guy's going to do, and I need to price that in?
It was almost like we went into the Fed meeting with a hike. You know, you heard just before, like, oh, the street's saying they're going to give a surprise hike. And so I think that was built in a little bit, and then that came off. Okay. So it was almost like a cut. But then, okay, so here's the other thing. Signal from the markets, right? That was a big thing yesterday. It's like, we're going to listen to the market. If you listen to the market yesterday, it made no sense. All right, the dollar tanked. That's usually bullish. We had yields, the front end down, which is almost like a hike. Steepening is bullish, yet equities got crushed.
Yep.
None of that makes sense. So a lot of this day to day, and if you watch the S&P yesterday, it just gets a sense of if you're listening to the market, it could change its mind within 10 minutes. The S&P was down, rose all the way into green, and then fell to the end of the day. A lot of this is algorithmic trading, AI, and computers that are driving markets. So if you're letting the market tell you what is going on, it's a lot of AI and algos. Is that really what we should be listening to as the Federal Reserve? I'd rather it be, hey, we're looking at fundamentals. This is what the economy's doing. That's what we're focused on. I got more, but I'll let you go to the next topic.
As a strategist, did you change your outlook? Did you change your allocation? Did you change your view yesterday?
So, the one thing that our team, late last night, we were just all chatting again, and insurance companies, regional banks, what are your part of the equity part of the portfolio that like higher rates? Because there are things in a portfolio that do well with higher rates. A steepening yield curve. Banks love it. Regional banks in particular have been holding up well. They're doing really well year to date. Insurance companies, they actually like higher long-term rates because they can lock in liabilities there and they can issue insurance.
Well, let me ask the elephant question in the room, and with the heritage of John Hancock and Manulife, going back years, do you see a yield regime shift where the matching liabilities out there somewhere don't match because we're in a new regime?
I think right now,
thinking annuities, thinking long-term obligations, actuarial assumption. Let me cut to the chase. Does the actuarial assumption shift with what we're living?
Well, here's what we're seeing is basically people are living longer. So that is, I try to use a golf analogy, but it's like there's more par fives. You need to be okay with your driver on this. And equities are better for long-term liability matching. That being said, when the 30-year yield goes up like this, we can now match people that are living longer. And that had been the problem. It was that, hey, if you want an insurance or annuity or what have you, it was hard to say we can do that for you for a certain long period of time. If yields come up like this, it actually gives us an opportunity to liability match to get it done. That being said, look, I don't know how much longer the yields will rise like this. I think if yields keep rising, if the 30-year yield rises to like 6%, I think something breaks. And I don't think this is sustainable at this rate. So you got to take advantage of while it is happening. And that's why I think these kind of companies are doing better with it.
So what do you do on the bond market here? Do you take credit risk here, or you can just clip these government coupons? I don't care where you're on the curve, you're getting you're well compensated.
Yeah, we've got a mild credit bias. So it's not, taking, triple C credit or really even lower into the high yield space. But, high yield right now is yielding 8%. And we've got a little bit of that in the kind of double B part. High quality corporate bonds are now about 5.5%. So again, we're kind of that 5 to 6% yield.
With your study and the incredible linkage of history into finance at Babson, does this get solved? If we had a train wreck yesterday, which I think uniform around the world, if we had a train wreck yesterday, does he amend it? Does the president amend it? Do the other Fed governors, presidents rebel so we don't get to your 6% 30-year bond?
Well, that's the way that Warsh communicated it yesterday works until it doesn't. So it's fine while yields are still relatively contained. He's like, I just don't know at the September meeting, it could be like, hey, the bond market yields rose a lot. It worked. Like if it
can't repeat what we saw yesterday.
That's what I'm saying. I think this is a one-time thing into the next. I mean, Jackson Hole, he's going to try to set it up a little bit more, but I think into September. And there was a really good question.
He said yesterday, I'm paraphrasing, folks, I don't have it in front of me, that he has a blank sheet for Jackson Hole. And in the old days, Paul, they'd have a team of 15 young Turks, newly minted PhDs, assisting with paragraph 4 by this time.
It just, he said there was a lot of uncertainty, but not a lack of clarity. To me, I left with a lack of clarity and uncertainty.
You're not alone. David Rosenberg out with some research just this moment. The Fed chairman served up platitudes, but as is the case with the central bank, he offered no explanations or analysis, and that's kind of maybe what we saw in the market reaction yesterday.
Is it too soon to say I kind of miss Powell?
I got 30 seconds. Yeah, I kind of miss Powell.